Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
Let's start. We promised once again to spend 10 minutes or significantly less than 10 minutes on Iran. And I think we can hold to that because at this point, there is nothing to add or subtract from the discussion last Wednesday. And for those on the call who may not have been on the call last Wednesday or the Wednesday before, Exhibit C hasn't been modified enough for the adjustments in production or demand based on the Straits being closed for 6 weeks. But it's not too far off. And the U.S. will clearly be up. Saudi Arabia will be down. Russia will be up. The Gulf Arab countries will be down. Not as much as you think because they've been producing in the tanks. So if they get clear to start tankers through the Straits, it'll pick up. Now, demand here on this chart is flat. I think the next time we do this chart, demand will be down a little, frankly, just because of physical, countries in Asia just running out of product, running out of diesel, running out of jet fuel. So if we turn to Exhibit B, which has oil and gas pricing from last Thursday, gas is weak. One of the problems is as higher oil prices and the strip for 27 is kind of around 70, and the strip for the remainder of 26 is kind of around 80. We were, before Israel and the U.S. began their campaign, we were at 60 on our way lower to something like 50. And the difference is that in the Permian, there will be more drilling, more completions, and gas production increases. Incremental gas production increases are 2/3 from the Permian. So Waha gas pricing, which is up out there this morning, stands at a -$6. Think of it. If you have gas at the Waha hub, you have to pay someone $6 to take care of it. So what has happened actually is that gas production, which in this table is 109 of dry gas production in 26, is running 107, 107 and a half. And the reason it's running at that level is rather than produce gas and have to pay someone to take it, the people are shutting in oil production and shutting in gas production, associated gas production. Now, a lot of the producers have pipeline capacity that they've committed for to the Gulf Coast. So it's the incremental gas that is in a really disadvantageous spot. Government revenues and expenses, same as last week. There will be more defense spending. The deficit has to come down. The capital markets, I don't believe, will stand for our deficit in 26 being higher than it was in 25. Revenue from income tax and payroll tax go up every year. Corporate tax should be up, and excise and tariffs and whatnot. We're running at around $250 billion. They're now running $500 billion. The difference is the tariff revenue. We cover health in this podcast, and I think Jason and Mike will agree that the Trump administration is doing a fair job, maybe a fair bordering on pretty good job of trying to flatten out Medicare and Medicaid spending, which of the $7 trillion of projected spending for the fiscal year we're in, Medicare and Medicaid are $1.8 trillion. So progress there is welcome. The all other category, which ran at under $1 trillion before COVID, was $1.3 trillion in fiscal 25 and is projected to come down to $1.1 trillion So the Trump administration is working on costs. The big problem, of course, is interest. Before we ran those big deficits, interest bill in the year before COVID was 400 billion. Last year it was $1 trillion. So that that you can't do much about. What we have to do, though, is we have to reduce the deficit and start to get to a point where debt levels are kind of holding at around 100 times or 100% of GNP. That is just absolutely paramount. I always ask Mike Jason, I know Jason's the most conservative of us all, so rather than say Mike and Jason, I'll just say, Jason, any additional comments?
I think a good starting point. Well, a starting point for the government to bring down costs of healthcare is price transparency. They've enacted a number of laws across both administrations to make that a requirement on hospitals, but as of now, there's been no enforcement. So I think that will be a big step on, being able to price shop.
Mike, anything to add?
Well, I think just slowing down the growth in spending is absolutely the most important issue. The growth rate that we were enduring before was unsustainable. And they're attacking it from a number of different angles. So part of it's going after fraud. Part of it's trying to bring down the cost of prescription drugs. Part of it's attacking the PBMs. So you have a bunch of different approaches. What's not clear to me yet is that these things will be permanent. It is. The fear is that, okay, we're going to have a temporary reprieve and then we will resume our 8% annual healthcare cost increase trajectory, which will be incredibly unsustainable. So despite being so controversial, this administration's done a very good job, but will we be able to transition this from a few years of reduced spending to something that's sustainable long-term? That is still yet to be determined.
Mike, Jason, I covered Iran very quickly. Any questions or comments on Iran? Impact on our capital markets, or impact on inflation, or impact on having enough of a disruption so that we get a kind of a worldwide recession? I'm fairly sanguine on all those things, but maybe I'm just too close to the trees, given all my experience as an energy investor.
Well, I think it's interesting that now the U.S. is the side blocking the Strait. If that continues for months, how do we not have a global recession? I mean, I think we're pretty insulated from the impacts in the U.S. here, but the rest of the world's feeling it a lot more.
I guess some of the signals that we're seeing is the luxury goods markets are all sort of taking a hit. I think Hermes reported earnings and pointed that in particular. You see the same thing with companies like Ferrari. Other ultra high-end brands are pointing to this as being a major issue. So that's where it hits first, and that's not that big of a deal. I think we still have some time before this becomes a major problem, but hopefully this gets resolved soon. Trump has explicitly said that we're done here. And obviously we're not totally done because we're blocking the strait, but hopefully there's a resolution in the future.
All three of us are proud to say we've only used 10 minutes and we're on to other things away from Iran. Enormous discipline for the three of us. We've been covering larger companies, and for those who have the 20 pages in front of you, we covered, in the process of covering some healthcare, we talked about Lilly as a kind of a dominant company, and this is 2 weeks ago, and I think the response from Mike and Jason, my saying is Lilly got the same position that Apple or Nvidia or Google or whatnot? The answer was from Mike and Jason, no, that they have done an incredible job with the weight loss medicine, but that they have some patent issues there, much more competition in store, and that while they've done a good job on other medicines, the weight loss just kind of is large enough so it outweighs everything. Have I misstated anything there, Jason?
No, and they have a really big oncology business and a huge portfolio of drugs, but they all have patent lives, and the moat is only as good as you can keep refilling a patent
And
through innovation
and fend off competition, because patents don't protect you if somebody comes up with a better mousetrap, so to speak. And
Right.
in a winner-take-all market, as most pharmaceuticals are, you can go from billion-dollar blockbuster drug to zero overnight.
Yeah.
Right.
Following last Wednesday, we covered NVIDIA. They seem to go from strength to strength. And of course, they're a cash flow machine. Here we got back to page 3 and NVIDIA, and this is kind of run rate as of the last reporting period, which was the fiscal year to January 1, something in excess of 200 million of revenues and something in excess of 100 billion of free cash flow. Think of it. It's after CapEx, it's after taxes, it's after paying all your operating costs, after doing all your R&D. Half of your revenue comes down to free cash flows. Remarkable. Two potential conclusions there, or possible conclusions there, is one, their margins are so high they won't be sustainable. The other is that they are. We decided that we're going to focus for the next bit of time on companies that really dominate their part of industry. NVIDIA is pretty dominant and is worth an awful lot of money. I mean, it's trading for $4.5 trillion. If we go to page 1, which has the other large tech companies, I mean, Apple's 3.8, Amazon's 2.5, Alphabet's 3.8, Microsoft is 2.7. So NVIDIA is not, times cash flow, it doesn't look that expensive, but it's just gigantic. And you shouldn't relate valuations to sales, but I mean, Apple has revenue of 400 million. Well, Amazon, of course, retails 700. Alphabet's 400. Microsoft's 320. So just with the chips and the other gear they do for data centers, they have 200 billion. And I think even the people that are somewhat bearish on NVIDIA kind of expect the 200 billion to go to 300 in the next 18, 24 months. So just a marvelous large company. Just want to cover it in passing for people that might not have been on last Wednesday. Jason, Mikey, have I misstated anything or left anything out?
No, yeah. I think that the thing to point out about NVIDIA is, considering the growth rate, considering the cash flow generation, it's cheaper, last time I checked, than the S&P 500 as a whole. So you're talking about probably the highest quality company in the S&P 500 trading for less than the average. So we don't really focus on the short-term moves in the stock price, but big picture, it's relatively inexpensive for what it is. And then the question always has to be, do we think that this company is going to continue to earn these outsized profits going forward? And that's what we went into last week. So I'll say go back and listen to that episode. and we covered that pretty well.
Yeah. One concern that's justified is circular revenue. And as you pointed out, they're making more than 100 billion in free cash flow, and they have to do something with it. And they're making tens or hundreds of millions of dollars in investments in AI startups. I mean, it's less than 1% of the free cash flow. And the vast majority of the revenue comes from the hyperscalers. So it's kind of, the concern's there because it was a real thing in the dot-com bubble, but I think here it's just such a small percent of their business that it's kind of not a concern.
Yeah, and at least so far, those investments have played out quite well. I mean, when they were doing the deals with CoreWeave and some of the other neoclouds, there was a lot of question marks as to whether these were too speculative, if you will. And right now, what we're seeing in the data center market is that there's a shortage of data centers, just broadly. You look at the explosive demand growth from Anthropic, you have Microsoft, which we'll get into later, who's actively curtailing capacity from its Azure hyperscale business, providing service to others so that it has enough for itself. So the demand is there. There's insufficient supply, and there's not line of sight to that supply demand gap being closed.
Microsoft is next. Microsoft is our target. Last week we said it would either be Microsoft or Apple. And since Anthropic, Gemini, the other language models are very much in the news and could conceivably be setting up lines with, especially on their commercial activity there, where large organizations, corporates are the users, that could cut into the more or less monopoly that Microsoft has with their Office products. They put in Copilot. Remember, they were the initial backer as OpenAI went from being not-for-profit to for-profit. They own, I believe, on a pro forma basis now, after the OpenAI latest financing, 25 or 30% of OpenAI. They, as Mike just said, they're in their Azure, their data center capacity, they're clearly have demand that exceeds the capabilities that they have in their data centers. Like many software companies, they've been off a lot. We were talking about relative valuation. I mean, their high price in the last 52 weeks was $550 a share. They're trading at $370, which is a heck of a lot closer to the low price. Despite high capital spending, they still have free cash flow. They are a superbly managed company. Then the next question is, and I don't know how many people on the phone are familiar with this term, and maybe I'm even misusing it, but are they a value trap? In other words, good business, good margin or valuation, but is the lower valuation justified by the way the world's going, way people are working on language models as a possible substitute for the Office product? So with that, Mike or Jason, one or the other of you have to take it from there. I've about exhausted what I can speak competently about Microsoft. So the two of you are going to have to carry it from here.
I'll start with a little history lesson. And then there's so many directions this can go because Microsoft is a very big company. But when Satya Nadella was named CEO of Microsoft was trading for, if not single digit multiple of cash flow, it was maybe 11 or 12. It was very cheap. But they had a history of making terrible investments under Steve Ballmer, who is interestingly now more wealthy than Bill Gates because he didn't sell any of his stock. But besides the fact, Satya Nadella transitioned the business to a subscription business. And that was a good business decision because that's what their customers really ultimately wanted. It enabled them to get more integrated with Fortune 500 companies to service their needs and set them up for where they are today. Going into the ChatGPT launch, they didn't have much of an internal AI capabilities. And so the decision to partner with OpenAI, the decision to invest in them early was a gutsy and, in hindsight, obviously very good call for the company. Interestingly, that set up sort of some conflicts of interest between them and OpenAI. OpenAI relatively quickly started to go wide by offering products directly for enterprises and in some ways competing directly against Microsoft Copilot. So as the growth accelerated, Microsoft has had to kind of assess where it's going to allocate resources. And the company's most recent earnings call in explaining why they actually missed their Azure number, they talked about how they had to decide what resources to allocate for themselves and which ones to allocate for the Azure customers. And they actively curtailed capacity so that they had it for themselves. And for themselves means to service the Office 365 apps, meaning when you buy Office 365 as an enterprise, you'll pay some extra money to get access to Copilot. So they prioritize those customers. So what's happening in the AI value delivery and capture? we know Nvidia did a very good job of building the core technology that basically everybody needs in order to train and run these models. They've done very well and are generating massive amounts of cash flow. The stack above that is the infrastructure. So you have AWS from Amazon, you have Azure as the second largest, and Google Cloud as the third. Those also are in incredibly strong positions, especially now because of how difficult it is to add additional capacity. Interestingly, Microsoft is adding capacity faster at a faster growth rate than the other two, than Microsoft and Google. It may change this year because Google announced a pretty big CapEx number. Amazon too, but the off a lower base. So the long story short is, I just want to bring us to where we are today, is Microsoft has this application, Office 365, which is sort of responsible for the majority of their cash flow. Obviously, there's a bunch of other add-on apps and all that stuff, but I try to focus on that because it's the core network effects, scale economies. It has all the things that the mark of a great product. And my belief is their decision to focus on trying to make Copilot better is about making that application layer that their customer uses more valuable. Now, whether or not that's the right decision or not is the ultimate question. That determines whether this is a value trap or whether this is a good buy.
Okay, here's why I think they have a good chance of succeeding in that. So Mike and I's workflow has changed in the last few weeks. We're leaning heavily on Claude Code. And we're not writing applications in source code, but at the end of the day, fundamentally, we're using Claude Code as a way to have language models manipulate a file system. And instead of source code on our file system, we have all of our research notes and things we're writing and articles from the internet and that kind of stuff. So it's really kind of like an agent in our operating system rather than a chat interface that you copy articles into and ask questions of and you get output there. This is manipulating the research files that we're actively working on. So I think that workflow fits much, much better with Microsoft Office rather than OpenAI. And at a high level, those Anthropic and OpenAI have diverged. OpenAI went the consumer route. They tried to build a video app called Sora. Anthropic's focused solely on initially software engineers, but the enterprise. And I think the OpenAI investment was a good decision at the time, but today it seems like a much more natural fit for Anthropic to be the part of the Office product rather than OpenAI. And they're actively making that change in the last 1-2 months. Right. So I think we'll see the fruits of that very soon.
And they claim that they think that they will have a leading edge model by 2027 of their own and internally designed. So Microsoft, they're investing heavily, and I don't know. It's not totally clear, but I do think if you're a Fortune 500 company, who would you rather trust all your data with? So far, that has been consistently Microsoft. So.
Jason, aren't you concerned as I guess Top Mark owns kind of a research position in Microsoft, but aren't you concerned that somehow they get disintermediated, that people decide they don't need co-work, they can just go directly to Gemini or Claude or to get their requirements, their research requirements or whatever they're using the language models for?
Sure. We're largely doing our work outside of a word processing system now, but it always ends up there in the end, as of now. So I don't see a case where we could do without it. And especially if that's how you're going to share files between people. We're not sharing our unformatted text-only markdown files that end up as like your working document when you're using these AI tools. You're going to share it in a fully formatted, rich format like Word, or finally export it to PDF or something.
Let's use the example of a legal document. You have a legal agreement trading sides, and lawyers on one side mark up that document and then send it back to the other side, and they do a diff. you can do that with code for sure, but it also needs to be human readable. So there's a portion of work that is going to remain interfacing with humans. There is an increasingly growing and likely to be many orders of magnitude larger portion of work that will not be human facing. So if you're going to make an argument against Office 365, it should primarily just be that the growth in that market of human facing side is going to be smaller, and that somehow Microsoft doesn't participate in the growth of the agent facing side of data manipulation.
Yeah. Well, one of the big challenges with using an agent is just how you communicate with it. And a lot of people are using it through the terminal. So if you've have some software background familiarity, the terminal is a very rudimentary device to communicate with. And otherwise, if you're using OpenClaw, you're trying to hook it up to these texting systems. We have like 4 different systems we're trying to use here. But if Microsoft comes in and streamlines it for the everyday user, and you just use Teams to talk to your agents and share work products, that owning that interface could be huge, whether the work product comes through as a Word document or not.
Mm-hmm. And the other thing, I guess, Teams is an interesting point because it's a communication tool that a lot of enterprises are using. Agents are very effective at using these communication tools and interacting just like a human. So how the next step evolves, whether it's sort of I train up my individual agent that's kind of trained on, I train it with all the things that I interface with, and then it acts as basically leverage for me. Or if an enterprise deploys its own agents specific to a role or a task or whatever, either one works well within the Microsoft structure.
I think that's good coverage. Do you have, just before we switch to healthcare, any commentary on the Windows product and LinkedIn and what they do with gaming and et cetera, that, let's say that's 30% of their business or 40% of their business. I mean, I would assume all that will continue to be reasonably healthy, but it's the Office product that's going to determine whether this is a good investment or a bad investment over the next 5 years. Is that a fair way to look at it?
Yeah, I think so. I mean, when I think about Windows, is my hope to see from them is building an operating system for agents. Mm-hmm. And today we're obviously seeing a lot of usage of the open source OpenClaw, which you can run on. You can actually run it on Windows now. But given Microsoft's experience with operating systems, they're in a very good position to create their own. And I think we'll see something out of that.
That's a good point. There's a lot of people in our position that we're firing up MacBook Minis just with the sole purpose of running an agent, and it would be better if there was an operating system tailored to that specific task rather than what we're doing.
Mm-hmm. Mm-hmm. Right. And if you're a Fortune 500, you really don't want your employees running around with Mac Minis that are potentially vulnerable and all the other things. So,
right. Good. Well, we're close to the end. We've got to do at least 5 minutes of healthcare, Jason. News events as it impacts the companies we're interested in, or just general news events in healthcare. What have we got to review this week?
It was kind of a lighter news week, other than a lot of M&A announcements. So that's continued at a very strong pace. We're seeing multiple deals announced every week now. The thing that hasn't happened yet, and we're on pace for I think one of the strongest years of M&A activity, which is kind of what we foresaw. But we haven't seen any of these huge deals be announced, anything 10 billion or larger. It's all been kind of single-digit billions for biotech companies. Outside of that, it still relates back to AI. Anthropic was in the healthcare news a lot this week, where they acqui-hired a small biotech. I think the team was 10 people total, and they
small, $400 million small.
Well, size-wise, the company was less than a year old, and it was 10 people. But yeah, they paid up for it, which is curious. So presumably they're targeting a product maybe similar to Google's AlphaFold, kind of research oriented. And on top of that, they announced that the CEO of Novartis is joining their board as well. So they're absolutely making a push here.
I mean, for the founders, the leading lights of AI, one of the rationales they use is to try to create better medicines sooner. Is whenever one of them's interviewed or they start to write about their...
That's the oldest pitch in healthcare AI, as Jason and I know, having built products in those spaces.
But it has huge value.
It absolutely, it's universal, right?
Yeah.
You look at the process for clinical trials and what it takes to get a drug to market, and if you could reduce it by 10%, that'd be great. But if it could be dramatically shorter, that would be amazing. And we talked about a while ago, I think we talked about this, how the administration started making some changes so that we can use digital models instead of some of the animal models that we know are flawed in the preclinical stages of research and development of these drugs. So it isn't just technology that's going to solve this. It's going to take changes in the regulatory frameworks as well.
I think there's going to be a lot of little things that get chipped off that add up together to reduce the time it takes to get a drug to market. And the more of those things you can add up, the longer the patent life at the end that you have a commercialized drug, the longer that patent life is, the more valuable it is. And these drugs are most valuable at the end of the patent life when they've built out the sales force and they have, all the patients are on prescription. And so if you can extend that, it'll have a dramatic effect on the value of every drug.
Great. Well, we've gone our 6 or 7 minutes over. I think next week we probably tackle Apple with this continuing theme of how does a dominant company look? Is there any potential for one of these dominant companies to become like an Intel? And then I think after that, probably a good thing to tackle would be Amazon, looking at Amazon, not just for their competition in Amazon Web Services, but their retail competition. I think it'd be interesting to look at Amazon and Walmart's efforts to compete with Amazon. But so that'll be the next couple of weeks, and I think it'll be a while before we run out of dominant companies to look at. So I think that's how we'll organize ourselves for the next few weeks. In the meantime, everyone be well and stay healthy. We will be here exactly 7 days from now, and thanks very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.